Hello, my name is Ann Wicker. I am the Research Program Manager for the Johns Hopkins AI and Technology Collaboratory for Aging Research. Welcome to our monthly webinar series. We took a brief break over the summer, but we are back with a webinar every third Tuesday at 12 o'clock. And today I'm really happy to introduce you to Daniel Kaplan, who will be talking to us about raising venture capital. And your chat box is disabled, but we have turned on the Q&A. So if you have any questions, you can type those in the Q&A. Daniel will address those questions at the end of his presentation. Thank you so much for joining us.
Anne, thank you, and thanks to JHU and to all of you for joining this morning and this afternoon. I appreciate it. Just to give a super quick background on me, I've been working at the intersection of senior care meets technology meets healthy aging for about 11 years. Part of that was spent as an operator at an early stage company that made web-based software for home care agencies. Then I had a stint in grad school. I got an MBA and I got an MS in gerontology, transitioned to the venture world in 2018, started working at a firm called Generator Ventures, which is the first and longest established kind of age tech venture capital fund. Worked there for a number of years, helped them invest the majority of their fund one. And then transitioned almost exactly about a year ago into Equitage Ventures. Equitage stands for Health, Equity, and Age. It's a firm that I've co-founded with two other wonderful people, and we are focused on partnering with world-class founders who are transforming the journey of aging. So today, I'm really happy to be talking to all of you, really kind of a high-level presentation about what is venture capital? How does it work? How does our math work? Who invests in these funds? How to best interact with people like me and with other venture investors and venture funds? What to do in that first meeting? And if you get a follow-up meeting, kind of what to put in your pitch deck. Then I want to talk a little bit about the senior care and aging market. And then I'm really happy to open it up to Q&A. I'll also just put this out there that these slides will be up on the website. So feel free to take screenshots or photos with your phone if you feel compelled to do so, but also you'll have access to all of these in just a few hours. So let's start. Let's get going. We got a lot of material to cover with Venture Capital 101. What is venture capital? Well, venture capital is a form of private equity focused on early stage companies with high growth potential. There's a lot of companies out there that have raised venture capital. Think Google, think Facebook, think NVIDIA. These are all venture-backed at one point, venture-backed companies. Venture capital is an institutional investor. We typically take minority positions in companies, and we usually take those positions alongside a syndicate of other investors. A lot of times it could be a family office, it could be a high net worth individual, it could also be other venture capital investors. And actually, who's in a syndicate is actually something that sometimes we actually look for when we're doing diligence on a company. Who else is around the table? We typically invest in preferred equity, often with special rights, things like information rights and pro rata rights. Of course, sometimes these rights or these terms can be a bit more draconian, depending on the stage of the company, the market environment, etc. Most venture investors will look to get a board seat or a board observer seat. And in addition to preferred equity, we can also invest in convertible notes that sit on the books as debt until they convert to equity. We can invest in safe notes. We can invest in promissory notes. There can be warrants and things like that. But for the most part, we like doing preferred equity. It's the way that we like to do things. Typically, when we invest in a portfolio company, and when I say we, I don't just mean Equitage. I mean, for most venture investors, there's typically a hold period of 4 to 7 years. Some funds go as early as pre-seed, so that's kind of alongside or just after kind of that friends and family round. Um, and then, of course, there's plenty of venture funds that are later stage funds. They're a growth equity investor or crossover investor, kind of right before a company goes public, kind of shore up that balance sheet. And fund capital, and I'll get into this a little later, is provided by limited partners. That would be our investors, and general partners. That's people like me. So we do have a GP commit in every single fund to make sure that our interests are aligned with that of our LPs. So let's talk a little bit more kind of about how this works. So most venture funds are a 10-year fund and split up into two periods. So the first period is called the active investment period. This is when venture funds can make new investments or build a portfolio of companies and do follow-on investments. Of course, an example of a follow-on investment, right, is, we invest in a company Series A and they go along and then they raise a Series B and we invest in a Series B. That's a follow-on investment. So kind of knowing where a venture capitalist and a venture capital firm is kind of in their fund is really important. If you're an early stage company and you're approaching a venture fund and they might be investing out of a fund, and they're in year 4 or year 5 of their active investment period, there's typically not a good fit if you're in kind of the later stages of an active investment period to be investing in an early stage company, because really these investments, they aren't investments, they're partnerships. These partnerships take 4 to 7 years, really kind of sometimes 5 to 10 years to really, to really get to any meaningful like scale. So kind of understanding where a fund is in their life cycle is really, really important. Most venture funds, assuming things are going well, they have returns, they have some markups, are going to be raising a new fund in year 3.5 to 4 to 4.5 to year 5, because it's always nice to have capital to invest. The second 5-year period is really reserved for follow-on investments and for returning capital to LPs. And of course, capital is called as needed over the life of the fund. So when an LP commits to invest in a venture fund, let's say someone commits to invest $1 million, we don't send them a bank account, and wire info and say, hey, wire here tomorrow. We say, thank you so much. When we have a company to invest in, we're going to call a little bit of your capital. So that's kind of how capital calls work. On the construction of the portfolio side, most funds are going to look to lead or co-lead or participate in investments. Leads typically price around. And if there's anything having to do with warrants or liquidation preferences or board composition or anything like that, leads are typically the ones that negotiate that. It's definitely an extra amount of work for a venture fund to lead a round. And I think a good question to ask venture investors is, do you lead or co-lead? And I think you'll find that there are some funds that do a mix. They lead or co-lead, or they participate in a financing. Others will say, no, we only lead. Others say, no, we never lead. So there's a variety of approaches, and I think it's important to ask investors about that when you do meet them. When most funds invest in a company, we typically deploy, I don't know, 25 to 50% of the capital that we would have earmarked for that partnership with a founder. We typically deploy about 25 to 50% of that capital in our initial investment. We don't deploy more than that because these companies take a long time to get to where they're going. There's future rounds. And we really need to reserve capital so we can be sure that we can continue to support our founders. A lot of times, and you're seeing this more and more, venture capital funds are trying to match portfolio companies or companies that they're doing diligence on with their interested LPs who might want to make a direct investment or potentially be a customer or serve as a distribution channel for the company in question. And I think that that's very important, and we'll talk about that a little later today. What I want to get to now is just VC Math 101. I think this is really important. We're going to go through just a really basic example, and then we're going to kind of do like a top-down look of just the economics of really how these funds work. So let's take a hypothetical round, right, where the company has a pre-money valuation of $15 million. Typically, this is negotiated with the lead. Let's say the company's raising five, and the post money here, the math is very simple. It's pre-money plus round size is your post money valuation of the company. So here, the dilution is 5 on 15. So at the end of it, 5 million of the resulting 20 is investor capital. So dilution is 25%. I think that's pretty simple. You should all get that. Let's say that you're a VC fund, the round was syndicated, and maybe a VC fund said, hey, we're going to do two. So their fund ownership after the round closes is 2 out of 20. They own 10% of the company. Of course, what we haven't considered in this example saves convertible notes, venture debt, LPREFs, pay to plays, all this other stuff that is very relevant. But I think it's a bit too nuanced for today's talk. But I do think that the math over there on the left, it's simple, but it's also powerful, and it's something that you should be very familiar with, because when we're talking about a priced equity round, we're talking about an investment in you, in your company. So it's all about you. So you gotta know it. Over on the right, it's all about us. It's about how we really do our business, how we stay in business. And I think that this example it goes a long way to really show founders and other people that we really do need big wins to stay in business. So take a hypothetical venture capital fund size of $50 million. If you look at the enterprise value of that fund's portfolio, that in other words would almost be like if you added up the most recent post-money valuation of all of their companies, right? Like what's the total value of the portfolio? Let's say it's $2 billion. That's a lot of value. Let's say that, kind of the average portfolio company ownership at exit when this company is either acquired or merges or goes public or goes out of business. Let's say on average, the venture firm owns about 5% of each company. So you can kind of back in and see that the total value of the portfolio is $100 million, and the gross multiple on invested capital, MOIC, two LPs of 2x. I should almost say of only 2x. You can see that with a $50 million fund, man, the right moves that were made to really help create $2 billion worth of value, that's pretty incredible. But at the end of the day, of course, ownership really matters. But at the end of the day, LPs are only making 2x, and this is before fees and carry. That's why I put gross MOIC, not net. So I think that just kind of, this isn't like a call for help saying, hey, our job is really hard. But I do think that it's important for founders to kind of get an appreciation for kind of the size of the wins that we really need to stay in business. And staying in business for a venture capital firm really means that we're able to raise additional funds so we can continue to invest in and partner with people like you. So who's investing in venture capital funds? I like to split these kind of into two buckets. The limited partners or LPs, as we say, typically they're associations or foundations or pensions or endowments or high net worth individuals and their family offices. Could be sovereign wealth funds, could also be corporates too. We'll talk about corporates in a minute. Why do people invest? Well, it's they invest to generate outsized financial returns. It's also a great way to diversify a portfolio that's already invested in fixed income, equities, real estate, or private equity firms as well. So it's a great exposure to private markets. Also, LPs will invest for direct investment opportunities. This is something that's really exciting that I'll just talk about in a second. And also this kind of goes along with it. They're also investing to get early access to best-in-class founders and the companies that they're building, and that's really exciting. So kind of along the lines of like LPs, we like to talk a lot about strategic LPs. A lot of times this falls either in the high net worth individual category or in corporates. So, for example, if you're a venture capital fund that's focused on senior care and aging, maybe having limited partners from the Medicare Advantage world or the senior living world or the skilled nursing world or home health or home care world is beneficial to you because it's not just capital that they're investing. You now have relationships with money in your fund that could represent distribution channel or a potential customer or a partner for any number of companies that you're doing diligence on or that you have invested in. And so this is a lot of times why corporates will invest in venture capital funds or do venture themselves. And a lot of that also plays up to their ability to have a direct investment in the company, oftentimes alongside the venture firm that they themselves are LPs in. Um, and look, that really kind of plays to kind of the corporate's ability to be more than capital and the venture fund's ability to be more than capital. And I would stress to all founders out there that look, the venture capital world over the last 10 to 15 years has become a lot more fragmented. There's a lot more funds out there. A lot of funds are specialized. I think the fragmentation is really to the benefit of founders, I think. And I think that because a lot of these funds that are out there, they have really purpose-built LP bases. Um, and to be able to partner with not just a generalist investor, but an investor who really knows your space inside and out and can actually be more than capital through relationships in their network and relationships with people who have backed them, the investor, is really powerful. And I think that that's something that especially if you're building in senior care and aging, especially if you're building in healthcare, where sales cycles are long, evidence bases are needed, tech adoption is slow and lagging. Having direct access to potential customers and distribution channels and partners really goes a long way, and oftentimes it's almost more important than the capital that the fund is actually investing in your company. So let's just talk a little bit, just really quickly, about how this works at Equitage. I kind of already talked through it, but we have a number of LPs that come from the senior care world, the healthcare world, the long-term care world. They give us investment capital and domain expertise. And of course, we pair that with everything that we know and everyone that we know, and that manifests itself in our investments in portcos. Those portfolio companies, we're sending all of them back to our LPs because these portcos represent best-in-class founders, executives, tech, services, and of course, direct investment opportunities. And sometimes the relationships that LPs kind of start up with our portcos could drive a lot of value and mitigate the risk of our portfolio. Of course, that comes back around, and healthy portcos could improve the performance of our fund and the business performance of our LPs. And of course, we're doing this. We're working with our partnership, with our LPs, and with our portcos to really fund and grow companies that provide access to services and tech that reduce total cost of care and increase health span and quality of life for older adults and those who pay for their care. That's us, taxpayers. It's important. Okay, let's talk a little bit about interacting with venture investors. Um, First thing, how do you get in front of us? How do you meet us? Um, Look, I think the number one thing, this is about relationships. Venture is very much a people business. I like to say that probably 75% of my job is sales. I'm going out, I'm meeting someone. When I started this job, um, I made it a goal to meet one new person a week. That's kind of how I built my network. I think for founders and for other investors, I think this is great advice. Right? Like stick yourself out there. And I think kind of with that kind of as an overarching theme, I'll get into this list. First of all, it's a relationship business. Get an introduction from someone that you know, or someone who you of someone who you know. I think that's important. Also, look, you're a founder. You know a lot. Share what you know. Share it on LinkedIn. Share it on Medium. Share it on the Substack. Right? Educate the market. I think venture investors, we're doing our jobs because we're curious people. Like that's why we love our jobs. We're curious. We're reading a lot. We want to know what you know, and we want to talk about it. So I really encourage founders to develop a perspective, develop an opinion, and share what you know with the market. Educate us, create buzz. You'll be surprised if you share your ideas out there in a public forum, people will come out of the woodwork and they'll want to talk to you about it. A lot of times that's going to be investors. Another great place to meet venture investors is at meetups and happy hours, and at conferences too. Also for these conferences, I mean, there's so many of these events that are focused on senior care and aging, right? There's the health conference, which is next week in Las Vegas. There's the NIC conference, National Investment Center for Seniors Housing and Care. They have a fall conference and a spring one that's all focused on the senior housing and senior living. There's Home Care 100, there's LTC 100, there's Senior Living 100, there's the AARP Age Tech collaboratives. They do a couple events every single year. These are great places to meet other founders, advisors, and investors too. And also, I think that for a lot of these, I think the hot tip is you don't need to buy a ticket. Hang out in the lobby, schedule a couple meetings ahead of time, and just keep an open mind. And you'll run into people. I do this still. Conferences are expensive and I don't buy tickets. Also, if you want to go the direct outreach route, which is totally fine and totally expected also by investors, I think it's best to probably use LinkedIn. Reach out to junior and mid-level investors at relevant funds because look, it's their job to source investment opportunities. And again, approach them with the intent to learn about their thesis and share a bit about what you're building at your company. Don't sell. You should inquire and educate. I think that is the best way to approach not only venture investors, but potential customers, advisors, new hires. Like this is the way that most people want to be approached. They don't want to be sold to. We want to be educated because we're curious people. Another community that I think that you should take a look at is the health tech nerds channel on Slack. This is a community that is absolutely thriving and vibrant. There's some venture investors on there, but there's a lot of advisors. There's a lot of other founders, and I just find it just a really just a community of people that is totally dedicated to making healthcare better, and more efficient and cost effective. And that Slack channel is popping every single day. It is just a great place to meet folks. So I highly recommend going on HTN and reading their newsletter every single Sunday morning. Also, talk to other founders, executives, advisors, experts. Talk to them. They will definitely know venture investors, and I'm sure that they'd be happy to make an intro. Last but not least, I think that when you're approaching folks, I know I said kind of inquire and educate. Um, when it comes to kind of framing what your company does, I think it's really powerful to, if you can boil it down to put it in one sentence, like that's a skill. But it really stresses on keeping your communication really simple and powerful and effective. So kind of talk about what your company does, but just in one sentence. Lean towards something more emotional, not literal. And I think it's best to, with that, you should make a statement about what your company does. So after you get in front of venture investors and you do have that first meeting, here's just a few kind of, pointers for how to really nail that first interaction with a venture investor. First, research the fund. What do they invest in? Who have they backed? What themes get them excited? You want to interact with a venture fund that could really actually invest in you and back you. And so it's important to do your research ahead of time to make sure that they don't actually operate in another industry, or is something else. I think that if you share materials ahead of time, keep the materials really easy, lightweight, and forwardable. And this last one is really important. If you think about, if you put yourself in the shoes of an associate, or a junior level person at a venture fund, and they get your deck, they get your pitch deck, or they get a high level kind of executive summary, right? Maybe after the meeting, after you've added some context to that deck, a lot of times, if they have interest in talking again, they're going to send your deck to other people in their firm. Most of the time, these people won't have been on the call. Most of the time, that venture investor isn't going to have recorded the call and sent a recording of the call to these people along with your deck. In other words, the folks who they send the deck to aren't going to have the context, that the person who you actually spoke with has about you and your company. And you want to make sure that you can add as much context about that just in the materials themselves. Pitch decks and fundraising documents shouldn't need a talk track, to have their ideas be brought to life. Once you get on the phone or get a meeting with a venture investor, I think it's important to ask them some questions. They're kind of interviewing you. You should interview them. Are they actively investing? What size checks are they writing? What stage of company do they invest in? If you're pre-seed and they invest in Series B, C, and D, probably not a good fit. And how do they add value beyond just capital? What I was just talking about before. Do they have any examples of that? I think that's important. Um, I think also just about kind of asking good questions and interviewing your VC. You need to keep in mind that you, as a founder, you are our customer. You're not going to hear a lot of venture investors say that, but I believe this with a lot of conviction, that founders are our customers. In fact, as venture capitalists, we have two customers. We have limited partners who put us in business, and we have founders who keep us in business. Without founders starting companies, what would I do all day, right? I wouldn't have really anything to do. So don't forget that you as a founder, that you are a VC's customer. Some people might not really get that, those people being venture capitalists. And I think that it's important for you to approach these meetings knowing that you are our customer. And if someone doesn't treat you like you are a customer, or at least like you are a peer, I don't really think that that's someone who you necessarily want on your cap table. Every single meeting you should end with a VC with a next step, and you should know if the ball is in your court or in their court. I think that's very important. And also, look, during this meeting, you want to educate your audience about the problem you are addressing, why you are the right team to back, and why now is the right time to build in this really large market. Right? Be careful about going too deep into how you actually solve a problem. We want to know that, but you should really try and keep it high level unless you're asked for more detail. I think technical jargon will lose most investors. Probably the fastest way to lose us is to go into things that are way above our head. And I gotta say that most things are above our head. So you gotta kind of have to keep it simple. Also, make promises that you can keep. I think when people are investing in early stage companies, when we're partnering with early stage founders, I like to say that we don't invest in early stage companies. We invest in early stage teams. We're really looking at the team and we're trying to assess the quality and the judgment of the person or the team that we're backing. It's all about building trust. So if you can make a promise that you can keep, and then you go keep that promise, it goes a long way. Here's an example. Um, I like to think that you should start your fundraise before you start your fundraise, meaning maybe 2 or 3 months before your fundraise actually starts, you should go out and meet venture investors. You should educate them. Don't pitch to them. Educate them about you and what you do. Then in 2 or 3 months, when you actually start your raise, you can come back and they're already kind of warmed up to who you are and what you do and why you're doing it. Now, you end that first meeting, that kind of education and just kind of general meeting with the investor, you end that meeting with a promise. And your promise is, we're starting our fundraise in 3 months. Are you interested in learning more at that time? And if they say yes, then go in your calendar and make yourself a reminder to reach out in 3 months. You're making a promise that you can keep. And when you keep that promise, when you do circle back in 3 months, you're building trust. And it's a small thing, but you're showing the investor that, hey, look, yes, I can make a promise and I can keep a promise too. And I think that's very impactful. Let's talk a little bit about elements of a really great pitch deck. I'm sorry in advance, but I'm going to just read off this. But I think that this is a great, I mean, of course I made it, so of course I think it's great. But I think that this is a good kind of overview of what to put in a pitch deck. So first and foremost, what's the problem? What's the opportunity? I like opportunity more. I think problem is a bit um, I don't know, it's a bit negative. It's a bit of a pessimistic thing where opportunity is optimistic. What's the pain of the customer and how is it addressed today? Then move right on to solution and talk about the value prop to your customer and maybe provide an example use case. Next, talk about the market. Why now? Why is now the right time to build a company in this space? Let's talk about trends, maybe customer trends, or the regulatory trends that make now the right time to build. Next, talk about your team. Honestly, I see team put towards the end in a lot of decks. I like going back to what I said earlier. We don't invest in early stage companies. We invest in early stage teams. Team is super important. It is the most important thing. Um, I see some folks put team as the number one, even before the problem and opportunity. I really think that problem slash opportunity, solution, why now, and then team, right? Why is now the right time to build, and why are we the right team to back to build? So I think it's very important. Then I like to kind of go off on kind of a deep dive into the product, right? The investor's totally primed. They know who you are, they know what you're doing, they know why you are doing it. And now I think it's time for a slide or two, just kind of on a deep dive of the product. That doesn't mean heavy technical jargon and documentation. I do think that you can put that in a separate presentation or in a white paper. You can get a little technical here, but you kind of have to go somewhere between high level and how it works, but don't get too technical. Um, Oftentimes, talking about a product roadmap is also very helpful to kind of show folks what you've built, maybe how much time and money it has taken, where you're at now, and then right, and then kind of what you see for the next year or two in terms of what you're going to be building. Next, talk about market size, show that it's a big market. You saw kind of in the VC Math 101 that we need big outcomes. Talk about the big market. You can do TAM, SAM, and SOM if you want to. But I think that kind of backing this up with, either a top-down or a bottoms-up analysis of the market that you are building in, the market that you're selling to, I think it's really important. And if you can, cite these numbers. Tell us where you got them from. Next, let's talk about your business model. How do you make money? What's the pricing? What's the average account size? What's the lifetime value of an account? What does it cost to acquire a customer if that's your kind of business? Then talk about your go-to-market. What channels are you selling to? Are you selling through payers? Are you selling through providers? Are you a provider? Are you selling to health systems, right? How are you getting your product in the hands of customers, in the hands of users? Then, right after talking about how you're going to get out there, how you're going to go to market, talk about your traction, right? Go back it up. Who's your customer? Who are your customers? Who's in your pipeline? Are there any relevant usage or product metrics that you can share? Next, I find it very compelling when someone does a kind of a case study of a customer. Oftentimes, these are customers that will have given you the green light to do a case. Don't be surprised if a venture investor gets very excited about you and starts doing diligence, that they'll want to probably talk with customers. They'll definitely want to talk with the customer in that case. And I think that here, kind of going like a little bit more nitty gritty, I think is really impactful. And you can really kind of, show how things are working, and talk about the value that your customers are getting out of it. Next, you got to talk about your competition. There's a bunch of ways to do this. I won't go into all of them, but a lot of times, it's a chart, features, and checkboxes, right? Financials next. Do keep it high level, but a P&L is very good. Talk about your current burn. Talk about your expected burn after the round, and most importantly, talk about the expected value created before your next round. This plays into the last slide, which I think is use of funds, right? You're raising $1 million. Why? What are you going to spend it on? And keep in mind that venture investors, especially for early stage companies, you're investing in a pre-seed or a seed round or a Series A round. We're really not expecting you to get bought or go public next, right? We know that these things take a while. So since we're in the business of generating returns, right, the next best thing that we can have is a markup. The markup being we invested at this price, then you went along and a year or two later you raised at a valuation that was higher than the one that we invested in. That's a markup. That's really kind of expected value created. How much value in the company are you going to create with this money before your next round? You don't have to say, look, hey, our next round, it's going to be a pre-money of 100 million and we're going to raise. You don't have to be prescriptive per se, but I think that you can show not with necessarily like those kind of words, but you can definitely show the value that you expect to create with the money that you're raising right now before the next time you go out to market and raise additional capital. Okay, we're through with VC 101. Let's talk a little bit about this market. Um, I'm going to keep this high level. I could talk for days about any one of these areas of the market, and I'm happy to talk with each and every one of you about the different nuances here. But let's just kind of do a high level. I'm going to segment this market kind of healthcare, CBOs, community-based organizations, which should arguably be part of healthcare, but I broke them out, and direct to consumer. So let's talk about healthcare. These are your potential customers. These are your potential users. High level, payer provider. For payers, you got kind of two buckets, I think. You've got managed care and you've got Medicare fee for service. For managed care, this typically means Medicare Advantage, Medicaid MCOs, ACOs, PACE organizations, et cetera. Managed care needs a strong evidence base to be a customer and for you to sell to them. Managed care is another word for healthcare insurance. Healthcare insurance is another word for insurance. Insurance companies are run by actuaries. Actuaries use actuarial models to do their jobs to figure out should they pay for something, and if so, how much. The input to their actuarial models is the output from your study or the output from your trial, right? So that's your evidence base. Keep in mind that managed care has sales cycles that are really slow. Their businesses are dynamic and complex and really subject to regulatory risk. Right now, payers are shifting their focus away from growth and more towards profitability. And I believe that it's best to start with smaller players. Let me explain some of this. So, particularly in the Medicare Advantage market, where Medicare Advantage now covers more than 50% of all eligible Medicare beneficiaries, 52%, I think, and open enrollment started today. So we'll find out, in January what the updated numbers are. They're getting pressure from two parties. One is top down. It's the regulators. They're tired of the risk adjustment games. They're tired of the financial engineering. They're tired of the reimbursement rates, and they are cracking down on the profitability of Medicare Advantage plans. If you follow Humana, if you follow United Healthcare, if you follow Centene or Alignment Healthcare, any one of these publicly traded Medicare Advantage plans, CVS, Aetna, you'll see that their stock performance has been all over the place. A lot of this has to do with them exiting markets or kind of a shift in benefit design, which investors think will impact enrollment. Now, because they're facing regulatory pressures and they think that their reimbursement rates will continue to go down, they are now also facing pressures from bottom up from the providers who are in network with them, right? The Medicare Advantage business model essentially is they get risk-adjusted capitated payment from CMS for each life that they cover. They have to spend 85% of those dollars on the medical care for each beneficiary. So, and they have to cover everything that Medicare fee for service covers, but they do not have to cover it at parity in terms of reimbursement. So a lot of times business model is Medicare fee for service pays this much and Medicare Advantage pays kind of in here. Definitely not here. Maybe here for some services, some preventive care, but a lot of it's down here. So in other words, Medicare Advantage is covering 52% of everyone who's Medicare eligible. That's the majority of the market. They control a lot of volume. Providers have their costs going up. A lot of them are actually losing money being in network with and working with Medicare Advantage plans. So providers are dropping out of network. Scripps Health here in San Diego dropped out of network with, I think, United Healthcare last year, or they dropped out of network last year, effective this year, this past January. They cited to the news that they were losing $75 million a year working with United because of the reimbursements and because of other things like prior auth. So you got to know these dynamics of of when you're approaching to and selling into managed care. It's a really dynamic business there. The dollars are really big and the impact that you can have is really big. Managed care is also on the forefront of value-based care. So they're an exciting customer and happy to talk more about that later. Next, and I won't go as in depth here. Let me just do a quick time check. Oh God, I'm running late. Okay. Medicare fee for service. I think this is often overlooked as a starting point for companies. A lot of folks are going to try and get in network with Medicare Advantage plans. That is, if you're a care delivery company. Medicare fee for service is probably the most obvious go-to-market channel for care delivery companies, and it's most overlooked. The CPT codes, I like to say, are your go-to-market. On the provider side, we're just going to quickly run through these. There's a big difference between home care and home health. Home care, this is personal care and companionship. They're facing a staffing crisis. They're fragmented. There's a lot of mom and pops. There's a lot of franchises. Most of home care is private pay, and increasing costs are clouding the prospects of growth. And I think this is very important because of the staffing crisis. The bill rates for non-medical home care right now are about 35 to $50 an hour. Most people can't afford that. So in the past, home care used to be the lowest cost alternate site of care, the lowest cost provider of care. I don't think that's the case anymore. And I think, again, that the growth prospects due to the staffing crisis is really kind of unsettling for the home care world. Next, for home health, like I said, they're squeezed by managed care. Managed care is paying them less than fee for service, and managed care is controlling the majority of the patient volume. Um, Future volumes for home health are expected to increase as we continue to see home health as a potentially viable alternative for skilled nursing. And home health is 100% in need of value-based care enablement tools. For senior living, they're also faced with a staffing crisis. The tech that they're using is fragmented. There's a lot of point solutions out there. Acuity of residence is increasing as people want to age in place longer or age at home longer. When they ultimately do move into senior living, their acuity levels are much higher than they have been in the past. There's a saying that basically the people in senior living today, the residents in senior living, 10 years ago would have been in a nursing home. Nursing homes are very different than senior living. So I really think that the outlook also for companies building in senior living is quite promising, and for the industry as a whole, because development costs, the cost to develop a new building are so high and interest rates are still high. Supply of new senior living beds is going to stay relatively flat, but demand is going up. So prices are going to be going up for senior living. Operators are having a party right now. Just to run through this, also on the right side, we've got SNFs or skilled nursing, staffing crisis for sure. There's an incredible amount of turnover, particularly among CNAs. The complexity in the regulatory environment is increasing. I'm sure you've seen that the Biden administration has imposed new rules for minimum staffing standards for nursing homes. That impacts, and they're different for rural SNFs and urban SNFs. Managed care is playing a bigger role in nursing homes with things like iSNPs, and SNFs definitely need better tech. Talk to any operator. They're primarily served by a company called PCC or Matrix Care, but there are gaps there, and there's a lot of opportunity to build for nursing homes. Hospice, it's misunderstood by investors, by families, by founders. I do not think it's well served by tech. It's fragmented and it's going to be playing a bigger role in value-based care and managed care in the future. Acute care, this is more hospitals. Sales cycle is really long. Hospitals and acute care providers are increasingly affected by the poor performance of post-acute care providers. That would be hospice, skilled nursing, and home health. When someone leaves the hospital and goes to skilled nursing, and then they get readmitted to the hospital because something happened, the hospital gets dinged by Medicare and their payment's actually lower. So there's actually a lot of opportunity to reduce readmissions or unnecessary readmissions to the hospital. Talk about primary care, there's a lot of value-based care tailwinds and headwinds. They're definitely all in need of better enabling tech and services to quarterback the care for their patients who are, of course, increasing in acuity. In specialty care, they're increasingly being brought into the value-based care fold. This is really important because they account for more healthcare expenditures than primary care. PACE is a payvider model, stands for the Program of All-Inclusive Care for the Elderly. It's really exciting. It's focused on nursing home eligible duals, or those individuals eligible for Medicare and Medicaid. Enrollment is really small. It's about 72, 73,000. But it's a very unique model, and just a great business to kind of have on your radar. For DME, that's durable medical equipment. I think it's underserved by tech and by founders. And it really is increasingly seen as a necessary piece of the puzzle. As more and higher acuity care moves into the home, the addition and integration of DME is absolutely crucial. How can you do hospital at home if you can't get a hospital bed and an IV in the home? So DME and timely coordination of DME is really important. We're almost there. Let's talk about CBOs and D2C. This is a non-exhaustive list of CBOs. First is AAAs, or area agencies on aging. They're underfunded. They're also very well connected within the community. I really like them as a place to go learn and to meet potential customers. Same with senior centers and same with Adult Day. I think Adult Day has really been overlooked. I think that it's poised for a ton of growth because I think it's the lowest cost alternate care setting. I think it's lower cost than home care. And I'm happy to talk about that at a later date too. Lastly, let's talk about direct to consumer. I think, this is all my opinion, I think that direct to consumer go-to-markets are not actionable until 2030. This is when all boomers are going to be age 65 plus. They're going to be more comfortable buying things over the internet and just more trusting of tech. Very important to know the kind of the income level of the 65 plus. And I have to put this out there. I do not like the segment of 65 plus. It's 65 plus is not, that's like saying we're serving the market that's 18 to 50, right? Like it's not helpful. Someone 65 to 75, very different than someone 75 to 85, very different than 85 plus or the oldest old. So I'm just apologizing in advance for saying 65 plus. Look, the median income of someone age 65 plus is really only $47,000. That's pre-tax, okay? The mean income is $75,000. Okay, that's 58% more than the median. That's important. That shows you that actually a lot of wealth is really kept up towards the top. The top 1-2% of older adults are really, I mean, it kind of mirrors the wealth gap that's in our country. So I really think that for D to C, you really have to think very, very, very deeply about who you're serving and why you are serving them, who your customer is and who your user is. Only 42% of people age 75 plus have retirement accounts. So while there is a lot of disposable income possessed by older adults, the multitude of disposable income is possessed by only a few of them. Look more at median than at mean. Okay, we're almost there. Parting thoughts. Simplicity in communication is powerful. That's kind of funny coming from someone who thought they'd present this in 30 minutes and it's going to take me an hour. Don't assume anything about the market. Talk to customers, talk to users. Listen first, ask questions second, and then go build. And maybe this isn't the right way to end this, but These are some reasons why I think innovative companies fail to raise money. One, there's no clear path to market. As you saw before, this is a really dynamic market, right? Maybe it's the wrong team. Maybe the product or solution is too far ahead of the market, right? I like to think that I want to invest in companies that are a few steps ahead of the market versus a few miles, right? The time for the market to catch up to a company is your runway, it's your capital burn, it's your capital efficiency. If you're here and the market's here, this is a shorter distance than like this. Um, Capital intensivity or unattractive unit economics of the company. There could be an unconvincing evidence base. The market could also be too small for a venture style return. And also, you could be building a feature and not a platform. That's way more nuanced than what I have time for. So, with that, I'm going to thank you all for your time. I'm going to stop my screen share. And Anne, have I got time for a couple questions?
Absolutely.
Okay, cool. Okay, great. Pre versus post. The pre-money evaluation is just the valuation of the company before the money goes in. Post is just the pre-money plus the size of the round. A bit more nuanced than that, but high level, totally that's how it works. Um, Let's see. Could you give an example of how you would work through figuring out company valuation from the founder side and just how to justify with potential investors? Sure. I think that valuation is it is an art and a science. Part of being good at it is knowing when when the art breaks the science. And I think that a lot of it has to do again with the size of the market, who your customer is, the health of your customer, the gross margin profile of the business, not necessarily net margin profile, right? You're not going to have net margins, but the gross margin, right, is just the cost, is just the business itself, just delivering the product or service. Is it profitable? And if so, what at at what level. It has to do also with kind of the capital intensivity of the business and all of that good stuff. Um, you also have to think about kind of how much dilution you're going to be taking. So I think that again, art and science, you can definitely look at forward-looking multiples in public markets. If you're doing more tech-enabled service, it's going to be more of a multiple of revenue that's probably between 1 and 5x revenue, maybe 1 to 6x for a technology company, pure play tech company with gross margins at scale above probably 70%. The multiple is going to be it's going to be higher. I think a lot of the ways that you do this is you kind of develop a relationship with some investors. You talk to other founders and you kind of see if you can back into it. A lot of times, a venture fund could give you a valuation. I think I'd probably, I mean, this is coming from an investor. I think I'd prefer that. But I have definitely been approached by founders saying, these are the terms, this is what we're doing it at, and so on. Again, I don't know if that answer is helpful, but really it's art and science, and you got to know when the art breaks the science. Um, I can give you a list of conferences, absolutely. Um, I'll skip this one. Will attendees receive a copy of the webinar recording? Yes, absolutely. PDPM case mixing as higher acuity moves into the home. How will things change? That's a really good question. Let's see. Um, for home health is very much being squeezed by managed care. They're also being acquired by managed care, right? Kindred was bought by Humana. United has bought LHC Group, and they're going to be closing on Emeticis very soon. And I think that kind of as higher acuity moves into the home, the value of home health will actually um, really start to stand out. If companies can help home health providers deliver higher value, better care to sicker patients, even building like a network of very high performing home health agencies. A company you should go look at is Tango. They're a home health convener. They're an interesting kind of middleman, kind of like a network builder of home health and goes in between that and managed care. I don't know. The PDPM question is a good one. I don't think I have enough time to get into that. Let's see. Falls. Okay, that's more of a false comment. I agree with you. Um, oh man, there's a lot of questions here. Maybe we should do a one just for questions.
And Daniel, let me suggest that
Yeah,
you take maybe two more. And then what I can do is copy these questions into an email for you. You can respond to the questions, and I can post that when we put your presentation on our website. So that could be sort of a sidebar to the presentation itself.
okay. Um, cool. Here, look, let's see. Oh, I know a lot of these people asking questions. Um, hmm. Let me talk to, okay, I want to address Bradley's question. And this will be my last one because I got to go to my next call. I'm late. Um, Identifying impact investors who are genuinely interested in the well-being of seniors and technology. Um, Look, you're going to run across probably two kinds of investors who are looking at this space. You're going to run across a generalist investor who knows that there's 10 or 12,000 older adults turning 65 every single day, and they think that's a big market. And so they're kicking the tires on companies. Then you're going to come across kind of more digital health investors who are kind of pure play healthcare investors and see this as a segment of the healthcare market that they're very excited about because Medicare kind of sets the tone for the rest of the healthcare world, and seniors drive such a disproportionate amount of healthcare spending in the United States. I think you look for investors who have personal experience doing this. I think you look for investors who have worked at startups before. I think you look for investors who have board leadership and board guidance experience, folks with actual exits under their belts. Again, I think that whole exercise of interviewing your investor is actually a really good one. I remember there's a founder, I won't say his name, when I was really young and early at doing this. I still am. Um, we had a 1 hour call and he honestly interviewed me for about 50 minutes. And he actually really sussed out whether or not I cared about this or not, which I do. I care very deeply about it, both on a personal and a professional level. So I think a lot of it, I mean, look, meet people in person, ask them deep questions, ask them actually like why they're interested in this, and also ask them how they can be more than capital to you and your company. And like I said earlier, if they are, if they say, "Oh yeah, we do that," and we did it for, okay, ask them for actual examples, right? You want to know, that this partnership, it's not really an investment, it's a partnership. That the partnership you're getting into, that this is someone who you trust and who you want to sell a bit of your company to, and they're going to be with you for a 5 to 10 year journey. So hope that answers your question.
Daniel, thank you so much for doing this today. And clearly, we'll be doing a part two with you soon. Just a reminder that this presentation, including the slides, will be posted on the Johns Hopkins AITC website within the next few weeks. And I have captured the unanswered questions, which I will forward to Daniel to respond to, and then I will post that on our site as well. Thank you, everybody, for joining us today.
Thanks, everyone.